Hi, everybody. This is Steve Gorin. Welcome to our annual Fiduciary Income Tax Refresher and Update. And I am here together with my partner Laura Duncan.
Welcome, everybody.
Thanks, Laura. Before we begin, we want to cover a few housekeeping items. If you have any questions during the webcast, you can submit them through the Q&A widget at the bottom of your screen. We will try to answer these during the webcast, but if a fuller answer is needed or we run out of time, it will be answered later via email. A copy of today's slides as well as other reference materials are available in the resource widget. You can find answers to some common technical questions located in the help widget at the bottom of your screen. This webinar is CLE accredited in California and Illinois for 1.5 general credit and in Missouri for 1.8 general credit. We award CLE based on attendance for the entire 90 minutes. From time to time, you will be required to click a pop-up screen to reflect your continued engagement. The certification icon located at the bottom of the screen will only tell you if you have met our criteria for awarding CLE. It does not include the certificate of attendance. Once we have verified your attendance, your certificate will be emailed to you later tomorrow. This webinar is being recorded and will be available within 24 hours. You can access it from our website, www.thompsoncoburn.com. All in attendance will also receive a link to the recording. Please do not hesitate to share it with other professionals who may find it useful. And of course, if certain parts stand out, then they can fast forward to the recording to those parts. We value your opinion and appreciate your participation in the course. All right. So in terms of the materials, we have slides, and we also have a very large PDF, and we're going to focus on concepts rather than examples. And at the end, at the very last slide, I'm going to mention other resources that we have for delving into any details that we don't cover in this particular presentation. We're going to talk a little bit about the 2017 tax law changes and post-2017 guidance about them. We'll talk about strategic income tax planning, just a little bit about integrating the 2018 changes to the Uniform Principal Income Act. We're going to go through kind of a top 10 list of tips for fiduciary income tax preparers. So when it comes to, now I'll start talking about the 2017 tax law changes. So I'm going to provide an overview. We're going to talk very briefly about electing small business trusts. We'll talk about itemized deductions. And we'll spend a little bit of time on the related revamping of excess losses on termination because we had some regulations that got issued last October. And very, very, very briefly about the Code Section 199A deduction for qualified business income. Laura, it's up to you.
Okay. So we're going to start today by talking about the 2017 tax law changes just very briefly. As everyone may remember, miscellaneous itemized deductions are no longer deductible through the end of 2025. However, expenses that are unique to trusts and estates are not considered miscellaneous itemized deductions and are deductible under Code Section 67E. For state tax income tax deduction, there is separate $10,000 limitations for both beneficiaries and non-grantor trusts. And you should consider that property taxes, unlike income taxes, are unlimited for trade and business or rental real estate. The changes for electing small business trusts, or what we call ESBTs, was that now non-resident aliens are permissible current beneficiaries of those type of trusts. However, if a non-resident alien is a deemed owner under the grantor trust rules, that portion of the income would be taxed to the trust and not the non-resident alien. The other change in the 2017 law regarding SBITs is now SBIT's deduction for charitable contributions that flows out on K-1 now applies the rules under Code Section 170, and those are the rules that apply to individuals instead of Code Section 642C. So there was one significant change in 2020 that we definitely want to talk about today, and that was the regulations that came out regarding excess losses on trust termination. And you'll see the references here on this slide to the two code sections, the first one being 642H1, which provides for capital losses and net operating losses passing to beneficiaries. However, under 642H2, excess deductions on terminations were not defined as to what kind of deductions those would be. And so until we had the 2020 regulations, those excess deductions were treated as miscellaneous itemized deductions, and as we just talked about, those are disallowed until the year 2026. So the final regulations, which came out in October of last year, classify these excess deductions on termination in one of three categories, and you'll see the 3 bullet points there. The first one being those allowable in arriving at adjusted gross income, or what we would call above-the-line deductions. The next category would be non-miscellaneous itemized deductions, and then the last category would be miscellaneous itemized deductions. And you'll see that the top one is the most favorable and the last one is the least favorable based on those rules that we just talked about. And the regulations confirm that basically the deduction retains the same character as it was in the hands of the trust or estate when it flows out to the beneficiary. So the final regs provide that to the extent the deductions are allowable, the taxpayers can pick and choose which deductions they want to use to offset income. So from that, it's clear that we should use less favorable deductions, starting with that last bullet point from the previous slide, the miscellaneous itemized deductions, and use those first to offset income. So hopefully what we're left with that carries out to the beneficiaries are the more favorable types of deductions, particularly if you can get an above-the-line deduction. So here's an example that I think will be helpful to you in seeing how these 2020 regs play out. If you have a trust that's terminating and you have $5,000 of income and $2,000 of tax preparation fees and $4,000 of legal fees, you'll see that we have a $1,000 of excess deductions. We have $5,000 of income and $6,000 of deductions. And both types of deductions, the tax prep fees and the legal fees, are what we would call above-the-line deductions, those more favorable types of deductions. However, before we got the 2020 regs, that $1,000 excess deduction would have been a miscellaneous itemized deduction and been lost. Under these 2020 regs, this $1,000 excess deduction retains its character as an above-the-line deduction. So here's a variation on that example. Instead of having $4,000 in legal fees, let's say that we have $4,000 in state income tax, which is not an above-the-line deduction, but an itemized deduction. We still have excess deductions of $1,000. When we prepare the tax return, you choose to apply $1,000 of the $2,000 in tax prep fees and the $4,000 in state income tax to eliminate the $5,000 of income. So we still have $1,000 of excess deductions, but under the 2020 regs, that $1,000 in excess deduction is an above-the-line deduction. So same as variation 1, but instead, let's say that we offset the income by all of the tax prep fees, the $2,000, and $3,000 of the $4,000 in state income tax. Again, we have $1,000 in excess deduction, but that relates back to the state income tax deduction. under the 2020 regs, that $1,000 excess is a regular itemized deduction, not a miscellaneous itemized deduction. But again, you'll see variation 1 is better because we were left with a $1,000 above the line deduction as opposed to a regular itemized deduction. So the final regs, which came out in October, are consistent with the explicit requirements of the code in that the personal exemption and the 642C charitable deduction are not excess deductions. But the preamble does confirm that the SBES charitable contributions, which are now the Code Section 170 deduction and not the 642C deduction, are now excess deductions on termination. And this slide just has a quote from the proposed regulations regarding the applicable dates. The proposed regs came out in May, and then the final regs came out in October of last year. And basically, the regulations will apply to tax years after 2017. So now we're going to move on to the 199A deduction. Steve.
Thank you, Laura. And by the way, if you want to amend your return for 2018 and 2019, the materials have details on where you actually will list the above the line deductions on the different returns. So, in terms of where you look at the materials, so if you'll notice at the very top of each slide, and sometimes at different parts within a slide, you see there's a parenthetical there. Like on slide 17 where we are right now, there's a parenthetical there that says Roman numeral 2E1C5A. So that's where you would go in the big PDF. So if you ever want to look through something in the big PDF, you can copy from your slide handout, and then when you have the big PDF open, you can execute a Control F for a find command. Control F is in find, and then you can paste the reference into that find command, and then the PDF will help you go to it. And I do recommend that you use the full table of contents within the big PDF to kind of search through things, because it gives you context to where everything is. And in the body of the PDF, the bottom of each page has a link that you can click on to take you back to the full table of contents. All right, so much for that administrative. We're going back to talk about, in slide 17, the 20% deduction for qualified business income. It's a very complex thing. I'm not going to spend any time really going through it, other than to say that there's certain taxable income thresholds, and those taxable income thresholds will determine whether you have to apply certain rules within it, and also whether certain types of businesses are eligible or not. And so if your taxable income is below the threshold, then below the bottom end of the threshold, then you'll get the full 20% deduction. And if it's above the top number, then you have to apply all of the limitations within that, and you may get only none, part, or all of the 20% deduction, and there's a phase out in between. So we just have here listed on slide 17 what the threshold amounts are for taxable income, so you can just see how they got updated. Now we're going on to slide 18. So trust and qualified business income. So grantor trusts are disregarded, and their Code Section 199A items are attributed to their deemed owners. And if it's a non-grantor trust or if it's an estate, then you figure out who got how much of the distributable net income. And we'll be talking a little bit about D&I a little bit later. But you just would prorate the various items of qualified business income and wages and UBIA based on those, the proportion of distributable net income that goes out to the beneficiaries versus what comes into the business, whatever stays in the trust. On slide 19, these are just kind of more technical issues about how you apply these rules. Again, Roman numeral 2E1F, the materials goes through details. And then on slide 20, we talk about rental real estate. And a lot of people get nervous of does real estate count as a trade or business? I mean, basically, I think, you know, if you're working in it, then it does. If you're not working in it, then it might not. A lot of tax practitioners cried out for safe harbors, and the IRS gave safe harbors, but those safe harbors are more or less worthless. And you can see in that last quote on slide 20 that if you fail to satisfy the requirements of the safe harbor, you can still get treated as a business. So an example would be under that revenue procedure 2019-38, a shopping mall that basically has triple net leases with its tenants would not fit within the safe harbor. But a shopping hall would clearly be a trade or business. So that's an example of one that would qualify. All right, and again, I'm not going to belabor 199A. It's kind of getting to be an old topic now. I do want to mention that Biden's proposal would take away the Code Section 199A deduction for people who have taxable incomes of more than $400,000. I don't know how that would apply to trusts, because trusts taxable income thresholds are at the higher levels with individuals. So I would think that the trust would have to have taxable income of $400,000 or more. But again, trusts are in the highest tax bracket after they have about $13,000 or so of taxable income, and so I'm not sure how Biden's proposal would affect that. We haven't seen anything written down yet. We probably won't until the summer or fall or even year end. So Lord only knows how that's going to work out. Okay. Slide 21, again, is more details when I was mentioning about the shopping malls. And the very last slide there is a link to another TCLE, and you can see the first part of it talked about that Code Section 199 safe harbor. So if you click on that link, you can go to a recording, and then you'll see the first, third of the webinar, plus or minus, will go over those issues. Now, the multiple trust rule, basically, this has been in the code for a long time, and the IRS never gave us any useful guidance on this issue. And so the issue is that if you have the same person who creates multiple trusts for the same people, then you have to collapse those. And with the advent of having the state and local tax deduction being limited to $10,000, and also with your QBI, those various taxable income thresholds, there's a little bit more incentive to have multiple trusts. I don't think that many people will try to get multiple trusts just for that sake, because it's just a lot of administration, and it's not worth it for the state and local tax deduction anyway. But basically, the IRS did start getting serious, and it had proposed regulations that were really overreaching to try to collapse trusts. And I led the task force on the QBI rules and the multiple trust rules, and we pushed back very strongly against what the government was going to do. And they just kind of threw in the towel and said, okay, just look at the legislative history. That's going to be your operating rules. The problem is that the legislative history is very confusing, and it seems to conflate whether you have substantially the same primary beneficiaries. There's some ways that it might be read where you might actually have to count remaindermen, and I don't think that that's necessarily the best reading, but it does worry me a little bit. And I think it would be good to, if you have multiple trusts for the same beneficiaries, or even if you have a trust for son and a trust for daughter, I think it would be a good idea to document the non-tax reasons for multiple trusts. Now, we as a estate planner know that you never know somebody until you shared an inheritance with them. And we know that siblings may or may not get along when mom and dad are alive, but when mom and dad are gone, then the gloves come off. So it's good to have separate trusts just for the sake of not having the siblings fighting about how the trusts get managed. And if you are going to have multiple trusts, you might want to consider just putting something in the file that says we don't want the brother or sister to fight with each other. So just a thought, just a sentence or two, nothing fancy. But if the IRS comes back and fights you on the multiple trust rule, then you'll have something there. Now going on to Laura.
So we're going to move on now to some strategic income tax planning issues. And slide 24, we're just going to give you an overview of some of the topics we were going to cover today. Who is best taxed on gross income, the effect of the kiddie tax rules on rates, who benefits most from deductions, some of the state and local income tax issues, considering trust purposes when we're talking about distributions. And moving on, we're going to talk about the effect on future years, how to create some flexibility in trust income taxation, planning for excess losses, and the Code Section 645 election for treating trust to be taxed as an estate. So going on to slide 26, the first topic, who is best taxed on gross income. So when we're looking at distributing out, making distributions to the beneficiary and who is best taxed on trust income, whether it's the trust or the beneficiary, one of the things to consider is how increasing a beneficiary's AGI could cause some negative impacts to the beneficiary. And we listed a few here. For example, as AGI increases, it may cause a reduction in itemized deductions for the beneficiary, such as medical deductions or casualty losses, which are reduced as AGI increases. It could cause a phase out of the AMT exemption, the phase out of the personal exemption from years 2026 and after, and could potentially push the beneficiary into exceeding the threshold for the net investment income tax, because as a beneficiary's income increases, they could be over that threshold, and we're going to talk about what those thresholds are in just a few minutes. Also to consider what loss carryovers the beneficiary might have, particularly capital loss carryovers that they could use to offset income that may be distributed to them. So if a beneficiary could be in a top bracket, but could reduce their bracket if they have these losses to offset against income. Slide 28, the effect of the kiddie taxes on rates. So the Secure Act put us back to where we were before, which is that the child's investment income is taxed at his or her parent's rate. Prior to the Secure Act and under the Tax Cuts and Jobs Act, they had changed that rule to have the child's investment income taxed at the trust rate. So again, we're back to those old rules. So the beneficiary, even if a child, could be taxed at a very high rate. However, there is no rule coordinating the net investment income tax, and as I mentioned, there's thresholds before you which you have to exceed to be within those net investment income tax rules. So a child has a separate threshold from their parents. So it still may be beneficial to shift some of that income out to the child and be able to save some of that NEAT tax. So next we're going to move on to Steve, who's going to talk about benefiting from deductions.
Thank you, Laura. So here we are on slide 29. And when you have a non-grantor trust, administrative expenses are above the line for trusts, and so that would be like tax prep fees, legal fees, things like that. So good things like paying your professionals. So those are allowed if they're just purely administrative. Investment management fees generally are not, unfortunately. So these tax prep fees and legal fees are above the line for trusts, and so having it be a non-grantor trust instead of having something owned directly helps with getting those deductions. State tax deduction, a non-grantor trust or an estate has its own $10,000 limitation, which is separate from the beneficiary, so you can kind of have more than one threshold based on having that. We'll talk about charitable deduction limitations later. Now I'm going to go on and talk about state and local income tax issues, starting on slide 30. And I'm kind of thinking about the trust's rate versus the beneficiary's rate. So of course you want to look at the federal income tax consequences, but the state income tax consequences are also very significant. Now, before I talk about the state, I just wanted to mention one thing about the federal, and that has to do with capital gains. So if a beneficiary has capital losses, then their effective tax rate on capital gains is 0 because they're offsetting those with losses. You may have a trust that's in the top bracket and a beneficiary in the top bracket, and you think, well, let's accumulate the capital gains in the trust. But if the beneficiary has capital losses, then you might want to distribute those out. So it's really important for the preparer of the trust income tax return to be communicating with the beneficiary's income tax preparer if you're going to do tax planning with distributions. And we'll talk later about tax planning with distributions. But from a state and local income tax perspective, so not only are we talking about the trust versus beneficiary's federal income tax rate, also the state income tax rate. If it's a non-resident trust, then there may be no state income taxation, but if you push that income out to the beneficiary, then the beneficiary would get taxed in whatever state the beneficiary resides in. So thinking about whether the trust is a resident trust or not, it can be a very important thing. And every year you should check to see whether the beneficiary is moved. In terms of grantor trust status, so usually a state will start looking at your residence if it's an irrevocable trust based on when it first becomes a non-grantor trust. So, for example, if somebody was a resident of, say, Missouri or Illinois, and they created their trust there, and it became an irrevocable trust, but it was a grantor trust. And then that person moved to Florida, and then after they were in Florida, they died or they otherwise turned off the grantor trust powers. I mean, death is a pretty effective way of turning off grantor trust powers, but there's other ways to do it too. And so then when you died, you were a resident of Florida, and so then you would test to see whether it was a resident of, so even though it might have been a Missouri or Illinois trust, under state law, from a tax viewpoint, it may be a Florida trust. Just again from an income tax viewpoint. Okay, so now there's some slides here coming up where we talk about the Supreme Court decision in Kaestner and some other issues, and I'm not going to really belabor the point on all of these slides. They kind of go through some examples or some particular language. The bottom line is that this Kaestner case was really limited to its facts, and the court did not address whether if distributions have been made to Kaestner to the could the distribution been made to the beneficiary while she was a resident of North Carolina, whether the trust could have taxed the trust. And in this particular case, the trust was going to terminate when the beneficiary reached 40, but the trustee decanted it into a new trust, and so it didn't terminate. And so decanting was a way that this particular trustee solved the problem of state income tax for North Carolina. And you'll see on slide 33 comment on California, so you can look at that comment, and you can also see that there's a case called McNeil that was not affected by the case. So again, you can go through the materials and look at that in detail. On slide 34, they talk about a variety of other states, and the Supreme Court just did not pass on those other states at all. So it really is a kind of a standalone idea here. Now we're going to move on to Laura, slide 37. Oh, 36, I'm sorry.
Right. That's okay. We're just going to talk real briefly about a couple other state income taxation cases, just so that you have reference to them. One of those is Fielding, which is referenced there on slide 36, which is a Minnesota case, which involved a trust that had S corporation stock. There was no question that Minnesota could properly tax the S corporation's Minnesota source income. The question really in this case was about the other trust income and whether that was properly taxed to Minnesota. And the court held that because the sole contact with Minnesota was the grantor's residence, it was not proper for Minnesota to tax that income. So you'll see that the limited holding in Kaesner, which had somewhat unusual circumstances, and the fact that the court denied cert in this Fielding case seems to indicate that the court's not going to give us much more guidance, at least not in the imminent future, about these issues. But it's still good to have references to some of these cases. And the next case on slide 38 is an Illinois case, and I know a lot of our Illinois friends have looked at this case very closely. This had to do with a trust that was an Illinois trust, but a trustee used his power to decant under a limited power of appointment to convert the trust to a wholly Texas law jurisdiction trust. It had no other connections to Illinois other than the grantor of this deceased grantor of this inter vivos trust being an Illinois resident. So there was a good holding in this case because of the decanting, and we're going to talk a little bit more about decanting later and creating flexibility in the trust, but obviously it had a good outcome for state income tax purposes in the Lynn case. So Steve?
Okay, so the next few slides are talking about state income taxation of business income, and I just want to make two basic points. And that is that when a partnership or an S corp, has a physical location in a particular state, that state is going to tax that income. There are other ways where states will have jurisdiction over a business's income operations, and it doesn't matter whether your trust is a resident or a non-resident. It's going to get taxed on the business income that is sourced to that particular state. And the other point is there's a potential for double taxation, and you can see at the bottom of slide 39 a reference to the Multi-State Tax Commission. And the bottom line is you can go, if you have double taxation going on that's wind up being unfair, you can try to work with the states that are involved, along with the Multi-State Tax Commission, to just try to get everything resolved together. So I'm going to kind of leave the next few slides to you to think about the issues. But again, when you sell a business on slide 41, you need to think about where the business assets are are located when they get sold. And really, if you go through, you'll notice at the top of slide 41, there's various cross references to sale of a business, and that 2H8A Romanet 2 goes into the nuances that are described in that third bullet point there, the second and third bullet point. So take some time to go through that if you have the sale of a business. Trust is selling a business interest. Okay. That's all I'm going to say about it, and we're going to skip on from business income tax and go to just some fundamentals here. Laura's going to talk about whether you actually should try to make distributions to save taxes.
Okay. Thank you, Steve. So we're going to talk about are distributions to beneficiaries to shift income appropriate? So one of the things we want to think about is the trust purposes. So if we shift income out to the beneficiaries, we want to think about protecting the beneficiaries from third parties, such as creditors, spouses, ex-spouses, and the government, protecting the beneficiary from himself or herself. There might be spendthrift issues, addiction issues, lots of other issues that may necessitate distributions not being distributed out to the beneficiaries. These are non-tax reasons why you may not want to do it. And also potentially avoiding estate tax at the beneficiary's death. And right now we have an increased estate tax exemption, which may change the SNED, although we don't really know how long we may have that increased exemption. So that's just something else to think about in terms of making distributions out to the beneficiary. So slide 45, we're going to talk about effect on future years. And one of the big issues that we're going to talk about today is capital gain distribution elections. In the first year that there's a distribution of principal, that trustee may be making an election that could impact future years. So we're going to talk about that, as well as turning on and off grantor trust powers. For example, a swap power might be included in a trust, and what are the effects of turning that on and off as to the grantor trust status. So one of the real keys for drafters is flexibility in trust income taxation. So when we talk about a support standard in our trust, we usually use the word support to refer to an ascertainable standard health, education, and maintenance support. So there are ways that still could be a flexible distribution standard. For example, does your trust require that you consider or ignore other resources of the beneficiary in making a support distribution? Also look at whether a welfare distribution is preferable. That could be done by an independent trustee to avoid negative estate tax issues. But we refer to welfare as opposed to support. Welfare is our non-ascertainable standard, which obviously could give some greater flexibility in making distributions and potentially decant a trust, which we saw in the Lynn case was very, very beneficial. And there's the 5% withdrawal right could be given to a beneficiary, which would make it a partial grantor trust as to the beneficiary each year. And we're going to talk about that a little bit later on. Steve, back to you on planning for excess losses.
Thank you, Laura. So for excess losses, you can't pass losses out other than depreciation during any year but your final year. Now, depreciation does have a very special rule for it. So you want to look at the materials, but kind of like the bottom line is that it's possible for the trust to report income from a pass-through, and the beneficiary reports the deductions from that pass-through, and the beneficiary's deductions that they report for depreciation may even exceed the income that the trust reports from that pass-through. So take some time for those people who do have business interests that are held in trust, and they do have significant depreciation reductions, take some time to read through the materials in that 2J, 11, A, etc. Take some time to go through that and look to see about getting those depreciation deductions. Laura?
Okay. We're going to next move on to the Section 645 election, which is an election made on Form 8855. And that election allows a qualified revocable trust to be treated as an estate and get some of the advantages that the estate has that a trust does not have. And some of those benefits are listed here, which would allow for a fiscal year as opposed to a calendar year, and potentially shifting income between years. But consider the 1099 reconciliation issues you may have on that. So sometimes people, I think, automatically assume one may be better than the other, but there are other practical considerations in making that election as well. Another benefit is a charitable set-aside allowable for estates, as well as the estate has an extended time to hold S corporation stock. So this election, if it's made, terminates in one of two ways. If there's no state tax return filed, then the election terminates 2 years after the decedent's death. If there is an estate tax return filed, the rules, the way they wrote them, are a little convoluted, but essentially it means 12 months after a closing letter is received is when that election would terminate. So now we're going to talk about some tips for our fiduciary income tax preparers out there. And this is just an overview of some of the things we're going to talk about. Talking about distributions after year end during our 65 days to carry out income to the beneficiary. Some ways that we can make capital gain elections that you might thought you were precluded from, that there is some flexibility in making some capital gain elections to carry out capital gain to the beneficiaries. Charitable distributions, which can count for the current year or the preceding tax year. Looking at possible changes in a beneficiary's residence, which may affect whether a trust is a resident trust or a non-resident trust. And material participation issues for the net investment income tax. We're also going to briefly touch on making a trust a partial grantor trust or a complete grantor trust as to a beneficiary, which permanently shifts income from the trust to the beneficiary. Trapping income in a trust notwithstanding distributions, and that would be with an electing small business trust, which S corporation income is taxed to the trust even if the income is distributed. And finally, modifying trusts to make them more income tax efficient. So our first issue, we're going to talk about helping our trustees, and this could be a really important thing for us to do as advisors, is helping our trustees to provide annual notices to the beneficiaries to reduce the liability exposure to the trustees. And Steve has a sample notice in his materials, but basically beneficiary needs to be provided with an adequately disclosed report showing, distributions, income, etc., as well as giving the beneficiary a specific reference to the time allowed to commence a proceeding. And if this is done, it can shorten the period during which a trustee could be sued. So we all would be looking at starting our rough drafts now in February to make some tax elections potentially, or making some decisions that could be helpful from an income tax perspective. And one of those things is, again, looking at a beneficiary's tax rate and posture compared to the trust income rate and posture. And so it will be important to communicate with the beneficiary's income tax preparers as to where they stand on things and whether some of these elections might be preferable. And one of those elections would be doing a 65-day election, which is making a distribution during the first 65 days of this calendar year, which would give us till March 6th of this year, that could potentially carry out capital gains to the beneficiary. And when we may want to over-distribute during that 65-day period, because then as the tax preparer, you can decide should that be treated as a 2021 distribution or a 2020 distribution, and gives you some flexibility there. So sometimes it's beneficial to over-anticipate those distributions, and then you can have more flexibility in making some of those elections. So our next subject, which is a really important subject, is how to make some of those capital gain elections. So I'm going to send it back to Steve.
So yes, here we are on slide 53, and I just wanted to point out the tax preparation software will tend to trap capital gains inside the trust unless you take special steps. But there are a lot of ways to get capital gains out to beneficiaries, many more than most people think. And we're going to discuss some strategic issues, the law, and some practical issues. So here on slide 54 is your list of your taxable income threshold for the additional 5% capital gain tax. So, the top bracket for capital gain is 15% generally, but there's an additional 5%, so that brings it up to 20% in order to be able to, in order to get up to a 20% rate. And you can see the trusts at a very low threshold are going to be subjected to capital gain tax, whereas a lot of the beneficiaries are not going to have this additional 5% tax until they get to very high incomes. And of course, we don't know what's going to happen under the Biden administration. So again, the 3.8% tax on net investment income. Laura mentioned earlier that you have the net investment income tax, which is passed in conjunction with the Affordable Care Act. It doesn't specifically fund it, but it's kind of budgetarily earmarked informally. And of course, we learned with Monty Python and the Holy Grail, this is the 46th anniversary of that movie, by the way, that the word "neat" is a bad word. And this is an interesting convergence because we're in the 46th anniversary of that movie that told us that "neat" would be a bad word. And this year, the 46th president of the United States was inaugurated. So I wonder if there's any conspiracy theories there. So anyway, so you can see here the tax on net investment income, and again, there's much higher thresholds for a beneficiary than for a trust. Now on slide 56, the actual literal language of the tax law is different than people's perceptions of capital gains. So look at the titles of this slide. Capital gain is distributable net income, which means that if you distribute it out, it carries out to the beneficiary. Capital gain carries out to beneficiaries unless it's excluded. Now, again, that's the reverse of the paradigm. But we will go through some of the details here. So capital gain is excluded only if it's from the sale of a capital asset and allocated to corpus and not paid out. Now, what is the sale of what is a capital asset? And here's what is not a capital asset. Believe it or not, under our tax laws, a building that is used in a business is not a capital asset. So you can have a multi-million-dollar business, a multi-million-dollar building requires a ton of capital investment. But if you're using that in your business or you're depreciating that, that is not considered to be a capital asset. And when that gets sold, Code Section 1231 will generally tax that as a capital gain. I'm not going to go into all the nuances of 1231 here, but that's a very common way to have a capital gain. That is not a capital asset, and any capital gain from that is automatically included in distributable net income and automatically flows through to beneficiaries, regardless of the rest of what we're going to say in a moment. So that's a huge exception that people need to think about. Now, on slide 58, here's our mechanism for distributing capital gain. So let's suppose it is from a capital asset, which could include, selling a stock on the stock market. So, or maybe selling your partnership interest can be a sale of a capital asset. And there's some rules of partnership interest which are a little bit kind of move a little bit away from that, but that's a much longer story that we're not going to get into now, but I'm happy to discuss it with anybody. So suppose you do have a sale of a capital asset and you have capital gain. If it's allocated to income, there's a way to pass it out. If it's allocated to corpus but distributed consistently, that's an alternative way. And that 65-day rule distribution, if you make a distribution by March 6, 2021, being able to count that for 2020, there's also a way to let that carry out capital gains. So you have 3 different ways, and any one of these 3 ways will qualify. Now on slide 59, if you allocate capital gain to income, that's typically done by what's called the power to adjust. And the idea here is that when you have a trust, you should be investing for total return. If you have a mandatory income trust, here's a typical example, mandatory income trust. You have the second spouse is the income beneficiary, and the kids from the first marriage are the remainderment. The second spouse is going to say, invest all for income to maximize the distribution to me. Don't give anything to those ungrateful kids who never spend any time with us anymore anyway. And the kids will say, hey, we got an evil stepmom there. You shouldn't distribute all for income. You need to grow this and grow it and invest only for gain. So there's a potential conflict for things like this. And so there's an idea of a total return trust. And the idea is that if you invest for total return, then what you might say is, well, maybe I'm only getting 1 or 2% dividends and interest every year, but if my total return is like 5 or 6%, then maybe it's fair to maybe have 2 or 3% or so go to the income beneficiary. So basically, a rising tide will lift all boats. If you invest for growth, then you're going to have more assets, more income and dividends, more gains, and then you'll have more that can be allocated to income potentially. So there's this power to adjust idea, and there's no duty of consistency from one year to the next, except with a unit trust. So if you allocate capital gain to income, you have a choice on how much to distribute to the beneficiaries as D&I. So on slide 60, I have some materials on the Uniform Fiduciary Income and Principal Act, and there's a bunch of slides coming up through here where we talk about the power to adjust. The Uniform Principal Income Act has been adopted in almost every state, and on slide 61 are the criteria for making distributions. And you can see, for reallocating capital gain to income. And you can see in the third bullet point, it says, the trustee determines that the adjustment is necessary to fulfill the trustee's duty of impartiality. Now, the Uniform Fiduciary Income and Principal Act, which has been adopted only in one state, but it's being introduced in a few states, and it's being worked on by several more. And all of you should try to get it adopted in your state because it's more flexible. Because you can see here that it says that you have to determine that the exercise of the power to adjust will assist the fiduciary to administer the trust or estate impartially. So it only has to be helpful. Whereas on slide 60, on slide
61.
Going too quickly. On slide 61, it had to be necessary. At the very bottom, they're necessary. On slide 62, it had to be helpful. And I was involved in drafting UFIPA, and I fought hard to make sure we got that in there. So everybody should try to adopt UFIPA in their states. And if you need any help with that, then just email me separately. I'm happy to discuss any questions you might have about UFIPA. The next few slides talk about the power to adjust and under UFIPA and the various rules to go in that. My materials do go into detail on both Uniform Principal Income Act and UFIPA. So just take some time to go through those materials. I am not going to go through all of those details. I will say that we, in our language, allow a power to adjust much more readily than any uniform law does. And your trusted instrument does override what's in these uniform laws. And in our forms, and this is in my material, a quote from our forms. Our forms say that you can adjust as long as it fairly balances the interests of the income beneficiaries and remaindermen. And there's very, very solid law on that being an appropriate standard. So all of these uniform laws are too restrictive, and you should really draft in your agreement around them. But you need to know the uniform laws, because a lot of times you'll be hit with a trust that you didn't help create. And those of you who are not drafting trusts and you're just preparing returns, talk to your individual income tax clients and have them look at their estate plan and see whether it has a flexible enough language. Unit trust, that's where you just have a flat amount instead of every year you decide what percentage can go out. You have a flat amount, and you're kind of stuck with that on a permanent basis. But UFIPA does allow you to modify the unit trust policy much more frequently than under current law for most people. So again, you want to go to UFIPA, and the power to adjust is much more flexible. Really, the main time that I want to do unit trust is when you have an income beneficiary who is susceptible to fighting, and that's when you might want to lock it in. Okay, so now we are up to slide 70, and so the allocation to income, even though you can have stuff in your trust agreement, you cannot depart fundamentally from the traditional principles of income and principal. So if you look in the regulations, those suggest that if you take the value of your principal, take the value of your trust and multiply it by 3% to 5%, that should be a reasonable range. I'm generally comfortable from an income tax viewpoint. I'm generally comfortable that the IRS will recognize allocating capital gain to income as long as you don't go above that 5% range, and then beyond that, I think you probably need to go to more effort to justify it. Now, from a fiduciary law viewpoint, you may or may not be justified in going, as high as 5%. And again, if it's a purely discretionary trust and there's no mandatory income beneficiary, then you're not going to really have any state law issues with it. The state law issues are going to come, your fiduciary duties, those are going to really come in more if you have a mandatory income trust. Okay, slide 71. This is a totally separate exception. And if in the first year that you have a distribution of principal and you have a capital gain, the first time that occurs, if you carry out the capital gain to the beneficiary, then you have elected to do that on a permanent basis. Now, that's only if you make that election under this particular example, but your records may need to indicate whether you're using this example, using this exception, or the income exception or the distribution exception that we're going to talk about in a minute. For most trusts, if your software defaults to trapping the capital gain, so most trusts are not going to be able to take advantage of this number 2. This way it's locking you in from every year, so it's not as flexible as the other 2. But I'd rather have the allocation to income or this actual distribution. If I have my choice, that's what I would tend to do. Again, nothing will fit all situations, so you need to use your individual judgment on it. But I would tend to want to stay away from this one. But again, you're not necessarily wrong if you do it, but I would tend to stay away because I want to be more flexible. On slide 72, actual deemed distribution, here's the deal. So as Laura was mentioning, we're going to do our 65-day rule distribution. So we're going to make a distribution in February or early or the first 6 days of March. And if the trustee says to the beneficiary, hey, I'm making a $20,000 distribution, this is a distribution of capital gain. Boom. You have referred to the capital gain. That's that second bullet point there. And then you can decide on your tax return how much of that $20,000 in my example actually carries through to the beneficiary. On to Laura on slide 73.
Okay, so we're going to move on to some fairness issues to consider in making distributions to the beneficiary. So we often have beneficiaries who are upset when they request a distribution for a particular purpose and then find out they have a tax bill associated with that. So it may be necessary to gross up that distribution to cover those taxes to the distributee. And that in the end, that may be better for the trust as a whole, including the remainderment, because it may cost less for that distribution to be made and for the income to be taxed to the beneficiary as opposed to being taxed at the trust level. So a couple issues to consider in whether distributions are advisable. First, looking at what are the provisions of the trust, and are distributions even available to be made, and to the extent we are drafting trusts, what provision should we include in there to, again, create flexibility to potentially carry out distributions or income to the beneficiaries? And also consider the protective nature of the trust with the income tax issue set aside. There might be other issues which cause us to believe it's better just to keep the assets or the distributions from being distributed out to the beneficiaries because the beneficiaries have other issues, and if we make the distribution out to them, those distributions might be lost. So in looking again at the provisions of our trust, we're looking at whether we have a support distribution or a welfare distribution, with the welfare being much more flexible. If we can appoint an independent trustee to make those distributions out to the beneficiary, it gives us a lot more flexibility. And as I mentioned before, whether even if you only have a support distribution, whether the trustee should consider or not consider other resources of the beneficiary, this could create some flexibility as to whether the trustee can make a distribution out. Additional tax issues to consider are what is the size of the beneficiary's estate, and are we increasing the beneficiary's estate that could be subject to estate taxes? And if we make distributions in kind out of the trust to the beneficiary, could those assets receive a step up in basis if they're included in the beneficiary's estate? So looking at the protective nature of the trust again, beneficiaries often have real issues to consider in terms of creditor issues, spousal issues, spendthrift issues. So putting the tax issues aside, it may not make sense to make the distributions out to a beneficiary. So Steve, we're going to go back to you about considering forming a partnership.
Thank you, Laura. So one of the issues under all variations of the Principal Income Act is that whenever a partnership makes a distribution to a trust, the amount of the distribution is the trust accounting income. And if you have a partnership that has, it has ordinary income and capital gains, and let's suppose it makes a distribution that would be enough to carry out both the ordinary income and the capital gains, then that capital gains is automatically included in income. And it's automatically included in D&I because it's considered to be a distribution of income from the partnership, even though it's a capital gain item. So my materials at 2J8E go into more details on that. On slide 79, the other thing that I would point out is that let's suppose the trust forms a limited partnership. Initially, the trustee is a 1% general partner, and then you'd have, maybe 98% limited partner, and somebody else maybe being a 1% limited partner, and then you distribute limited partner interests. So that's a distribution to the extent of the basis of limited partnership interest distributed. That's a distribution that can carry out D&I, but it's only a piece of paper, and the beneficiary can't spend it. So I go into a lot more details here with the partnership. This is not a very common thing that I do, but it is an option if you are having some unique challenges with your administration. So now we're going to go on to slide 80 with Laura.
So again, we're considering what are our ideal trust distribution provisions. So when we're writing trust, what are the keys to creating flexibility so that we have options down the road? So we could look at whether we're doing a support distribution or a welfare distribution by an independent trustee. And I just mentioned that sometimes instead of just a pure support distribution, we use the word support to cover all HEM standards. We sometimes use the term reasonable support and comfort, which comes out of the regs, to indicate that that's a broader distribution standard than just simply satisfying support obligations. So that's something to consider. And also consider 5% withdrawal rights that are exercisable by the trustee or potentially a trust protector. A lot of states now have trust protector laws in place that can create a lot of flexibility in our trust planning. And a trust protector or a trustee could potentially turn off that 5% withdrawal right, depending on whether a beneficiary has creditor issues or other issues. But again, this 5% withdrawal right could make the trust a partial grantor trust as to the beneficiary each year, with each year getting a greater and greater percentage going to the beneficiary. So using distributions for welfare, as we've seen, welfare can be a very beneficial standard if we have it in the hands of a person who we would call an independent trustee who's not a related or subordinate party under Code Section 672C to avoid any estate tax inclusion issues. But we could use that welfare standard potentially to make distributions that carry out capital gains to the beneficiaries and use some of that flexibility that Steve talked about in making those capital gain elections. And welfare can be very beneficial in terms of decanting, although a lot of states, including Missouri, now have specific decanting laws. If your state does not have that, you'll definitely want to look and see if there's a welfare distribution standard which could potentially allow you to decant the trust. And as we saw in the Lynn case, that was very beneficial from a state income tax purpose, that the decanting changed the nature of a trust from a resident to a non-resident trust and could save a lot of income taxes from that perspective. So now we're going to talk about charitable distributions, and that's the exclusive way to reduce net investment income tax. It is a way to reduce adjusted gross income that's distributed out to the beneficiary. It's more liberal than the 65-day rule that we talked about, in that a contribution made on or before December 31st, 2021 could count as a 2020 contribution or a 2021 contribution. And charitable distributions have to be made out of gross income. So those are just things to consider when looking at charitable distributions. And moving on to looking at a beneficiary's residence. And Steve touched on this before, but again, as tax preparers, it's really important to look at each each beneficiary's residence and see if there has been a change, because that could change a trust status from a resident trust to a non-resident trust. And again, states generally don't tax non-business income earned by a non-resident trust. So, for example, in Missouri, a trust has to have at least one Missouri resident to be considered a resident trust. So, and it's a snapshot taken at the end of the year. So, just again, a reminder that that's an important consideration in determining whether a trust is a resident or non-resident trust from year to year. Going on to Steve, talking about our net investment income tax and material participation.
Thank you, Laura. And I want to reiterate what Laura said. So that one of the most dangerous words in an income tax preparer's language is Sally, same as last year. So you do need to look at the beneficiary's characteristics every year separately and just don't make any assumptions. Those of you who know the movie Bad News Bears know what the word assume means. Okay, so on slide 84, material participation for business or rental activities, I'm going to go through a lot of this stuff very, very quickly. I have another webinar that I'm going to refer to on the very last slide that goes through a lot more details. So, and we just have a lot of things to get into this particular webinar here. So, basically, if you have passive activities, those generally are going to be net investment income, and so they'd be subject to the 3.8% tax. And you need to be, to work sufficiently to avoid that. The standard is significant participation if we're talking about it from an income viewpoint, which is more than 100 hours a year. And again, my materials and separate webinar go through all those rules. One of the even if the trust is taxed to the deemed owner and the grantor trust rules, you should consider having the trustee participate in the business. There are reasons for it relating to the sale. And again, there's a lot of pros and cons. You don't want to get the trust liable for the trustee's participation in terms of any torts that may be committed. So there's pros and cons to that. But the other thing is with this the depreciation deduction passing through directly on the beneficiary's return, the beneficiary might want to participate. And I have had cases where the beneficiaries are active in the business and the trustee is not, and we've been able to deduct the depreciation deductions on the beneficiary's personal returns. On to slide 85, a qualified subchapter S trust, which allows beneficiaries to be treated as a deemed owner and allows you to run through all the lower brackets before going to the higher brackets. It can be a very beneficial thing to have. But when you have the sale of the QSST, you need to do some advanced planning from the sale and thinking about whether the trustee should be participating in it. And my materials go into detail on this particular issue and how the IRS will treat things when you have a QSST, or if it's an ESBT that's a non-grantor trust. And with an ESBT, you need to consider a lot of times if it's a grantor trust to begin with, the grantor might not want to be taxed on all the gain on the sale, and you might turn off the grantor trust powers, or might maybe split the trust and turn off the grantor trust powers as part of the trust, and then you're left with a non-grantor trust, and you have to worry about the trustee's participation. So a lot of long-term thoughts when you have a sale approaching. On slide 87, a totally separate issue, there is a potential way to have a trust that's not deemed owned by the beneficiary to kind of morph that into being deemed owned by the beneficiary. And the materials go into this in more detail, so I just commend that to you for your reading. On slide 88, there's basically the discussion that we're about to go through goes over what's in this article that's cited here. But if you want a standalone article that goes through these issues, And you can look at my materials, or you can look at the standalone article that's cited here on slide 88. On slide 89, you can make a trust be a complete grantor trust as to beneficiary by this process of having the trustee contribute all of its assets to an S corporation, and then the trust converts to QSST. This can be a flexible strategy, but there are some serious issues on the back end when the trust terminates. Like if you have 3 different beneficiaries, there are some exit strategy issues that go along with that. And this, you'll see that this reference to slide 2J4G kind of goes over the issue of doing this conversion here, but there's a separate slide in the S corporation materials in the back that this materials refers to that talk about some of the logistical issues with that. And the article slide in the prior slide mentioned those as well. Slide 90, Laura.
This is just a reminder that qualified subchapter S trust is very similar to a marital deduction trust in that all income must be distributed to the beneficiary, and even if the income is discretionary, this will work if the income is actually distributed out to the beneficiary. Obviously, it's not as protective as a trust that accumulates income inside, and it is, again, similar to a marital deduction trust. It only has one beneficiary. As Steve mentioned, the Quist election, it essentially treats the beneficiary as the grantor, except on the sale of trust assets. So this is an important thing to consider if you're going to do the QSST election. The next slide is trapping income in the trust notwithstanding distribution. So alternatively, the trustee could contribute assets to an S corporation and then make an ESBT election. And even if income distributions are made, the S corporation income is trapped in the trust, and that may be beneficial. This can be turned off, and Steve's going to talk about turning off an SBET election in just a minute. So, Steve, you want to talk about the SBET?
Yeah, so an electing small business trust, again, when you have an irrevocable trust that owns S stock, it must either be a wholly owned grantor trust or a QSST or an ESBT. And an ESBT can be a sprinkled trust. So, Laura mentioned the requirements for a QSST, and if you don't meet those requirements, then you need to be in an ESBT if you're not a grantor trust. And in electing an ESBT, all the S Corp K1 income and all the gain from the sale of the stock are considered to be S Corp items, and they get trapped inside the trust while it's in the ESBT. And any what was I going to say? Well, there's some flexibility. I'm going to talk about in just one moment. Flexible design on ESBTs. So on slide 93, if you have a surviving spouse, normally, I'm really big on doing the so-called one lung plan where it all goes to marital deduction trust, and then you would typically do QSSTs from that. But if you wanted to still trap some of your income tax consequences inside the trust, you could make part of it. You could make it be an ESBT. Another point about this is kind of post-mortem. So let's suppose you have a revocable trust, and that makes the 645 election to be taxed as a state, and it can hold on to the S Corp election, the S Corp stock for as long as that 645 election is in place. Suppose you have a revocable trust and don't make that election, or suppose you had a QSST, or suppose you had some other trust that's taxed as a grantor trust, 100% deemed owned by one person, and that person dies. In all of those cases, you have some time after the deemed owner dies before you have to make some kind of election. That does not mean that you should sit on your hands during that time, because in many cases, the S Corp income will get trapped inside that trust and not distributed out to the beneficiaries. Whereas if you have a QSST, then you'd have all of the income tax of the beneficiaries at their rates, getting the full run-up in the brackets, regardless of how much actually winds up getting distributed to the beneficiary, as long as you meet the QSST requirements. So one thing to think about is when the deemed owner dies, again, whether that's an irrevocable trust or it's your revocable trust, consider quickly moving the stock into trusts for the beneficiaries, so what we call the downstream trusts. Quickly fund those trusts and make QSST elections so you can start getting the run-up in the rates in the beneficiaries' income tax brackets. Now, if you have a state tax due, that idea might not be indicated. But other than that, it's really, I strongly recommend thinking about this issue and not just rest on the fact that no election is due yet. At the drafting stage, it's good to try to make your trust flexible. And I mentioned a lot here in the materials. And like I said, I do have another webinar that goes into some of these details a little bit more that I'm going to mention in a moment. Another thing about flexible trust design for multiple trusts potentially is, suppose you have an ESBT and the S corp is distributing, most or all of its income out to that trust. If that so it doesn't matter how much distributions are made to the beneficiary. If the S corp stock is the only asset there, all of the income is still trapped inside the trust level, and none of it is taxable to the beneficiary, even if you distribute the whole thing. Now, suppose you have reinvested some of the distributions from the ESBT and you make distributions out to the beneficiary. That will carry income out to the beneficiary. One thing to consider is whether you might want to split the trust, and any distributions that are reinvested would get moved over into a separate trust that has its own distributions. Its own investments, and that accumulation trust is just accumulating its earnings. And if that's a non-resident trust, you can avoid state income tax by having those earnings accumulated, and then have all of your distributions go through the standalone ESBT, which doesn't carry income out to the beneficiary, and therefore you can avoid income tax in the beneficiary's home state. Slide 96, you can toggle between QSST and ESBT, and there you have whether there's a waiting period or not. On slide 97, there are ways to modify trusts to make them more income tax efficient. Laura mentioned decanting, and I'm not going to go into more details. The materials cover that. But Laura, you may have other comments too, so let me turn this over to you.
That's okay. I just wanted to make everyone aware that most states have adopted the UTC or some form of the UTC, and so now there's much greater flexibility for modifying irrevocable trusts. The UTC has a mechanism for the settlor and the beneficiaries to get together and do an agreement to modify trusts, which can be very helpful for making a trust more tax efficient. And again, potentially, if you don't have that available to you, having a trustee being able to decant, whether it's under a state statute or because there's a welfare distribution standard in the trust. And then our last slide here, before we wrap things up, is we wanted to talk about, again, how do we help our trustees limit their liability exposure, and there's things that we can do to help them. In Missouri and other UTC states, typically trustees are liable 5 years after the termination of a trust, but there's a way that can be cut back to 1 year, which obviously could be very useful to our trustees. And Steve has in his materials that have been forwarded to you, a sample notice that can be provided. We typically provide records on a flash drive, give them a table of contents and a receipt, and provide this all to beneficiaries. If you have litigious beneficiaries, basically they have to complain sooner rather than later. So you want to try to cut that off as soon as possible. And if you have a harmonious situation, it still makes sense to do it. Give the beneficiaries this notice while they're happy, and try to wrap things up for the trustee. So again, other things we can do to try to help our trustees. We'll go on to our last page here. Steve, you want to mention some of the other resources?
So yeah, all of you have the big PDF, so over 2,800 pages of materials. And if you do not already subscribe, you can click on that link to subscribe to get a quarterly update to that, the most recent version. And you also have a chance to subscribe to other publications, including some heckling summaries. There's another link here about other free resources that Thompson Code people to click on to see what you have. And CPA Academy, there's a free an organization that offers free continuing professional education for CPAs. And I do a lot of lecturing through that. And if you clicked on that webinar page, you'll see where I have upcoming or recorded versions of these various webinars. And this pass-through entities held by trusts is being rebroadcast and it is eligible for CPE credit for accountants. Sorry, no CLE for those. But it is eligible for CPE credit for accountants, and there are still some more sessions that are available. This morning, I had a rebroadcast of it with over 1,000 people attending. But anyway, so you can look at these webinars and go into a lot more detail on some of these questions. So what I'm going to do is we're going to answer questions for 3 minutes, and then we are going to have a very short wrap up, and then if you want to leave, fine. You've stayed long enough to get your CLE, and then we're going to answer some more questions for maybe another 5 or 10 minutes, and then we're going to sign off. So here we go with some of the questions, and one of the questions asks, how do you treat a trust that has a 5 and 5 power or what's called a crummy power? How do you do that reporting on a trust tax return? And the answer is that first of all, you look to see whether it's a grantor trust or not a grantor trust. If it's a grantor trust taxable to the owner, then none of that other stuff matters. If it's a non-grantor trust, then there's ambiguity in the law, and you can take a position that either it's a partial grantor trust as to the amount that can be withdrawn. Actually, I need to back up on this. The part that you can withdraw is definitely a grantor trust taxable to the beneficiary. But once it lapses, you can take either position that you wish. On the lapse portion, whether you've had an increasing percentage ownership or not. And that's because there's some ambiguity in the law. Okay, somebody else asked, can you accrue tax prep fee? And the answer is correct. You cannot accrue tax prep fee when you're a cash taxpayer, which pretty much all trusts are. Here's another one, Laura. You want to answer this about 645 election?
About the kin fees? Okay, go ahead. Can you tell me the question?
Yeah, so I'll read the question and you can answer. If the estate is on a fiscal year and the estate continues after the 645 election expires, can the estate continue to file in a fiscal year, or can it change the calendar year?
My understanding is that once that expires, you are back on a calendar year basis. So you may have to file a short year for the year. So, for example, you might have to file a final return for the estate for the period until the 645 election terminates, and then file a short year return for the calendar year remaining for that year, and then going forward, you would be a calendar year.
Yeah, and this is assuming that you're really talking about the revocable trust that elected taxation as an estate, and so the other question is really, if you do actually have a physical probate estate, then the 645 election would terminate as to the trust. The estate will still be taxed as a probate estate, as a fiscal year taxpayer, until it's determined that it was unreasonably prolonged. Yeah, until it terminates, or if it's unreasonably prolonged, and there's a lot of facts and circumstances for that. We had another question. Ever heard of using 65-day rule for a simple trust? Oh, you know what? Before, I'm going to do a wrap-up here, and then I'm going to answer that question. So we appreciate everybody participating in the webinar, and please complete and submit the survey that will display at the conclusion of the webinar. And definitely, please come back to listen to other TCLEs, and Laura and I look forward to further contact with you. So those who want to sign off can go ahead and sign off and get your CLE, and those who want to keep listening to questions, you can keep listening to questions. We have another 5 minutes or so we're going to stay on to answer questions. So the question was about simple trust, and Laura, you want to talk about the difference between a simple and a complex trust?
So a simple trust for income tax purposes means a trust with a mandatory income distribution and no principal distributions made during that year. A complex trust is any other type of trust. So it's either a trust that doesn't require income to be distributed, or it's a trust that requires income to be distributed, but there's also principal distributions. Now that changes slightly what the exemption amount is, but that's how you categorize trust for fiduciary income tax purposes.
So if we have a simple trust, and therefore there's no distributions of principal, and all we have is income, do we really care about how much is actually getting distributed from an income tax viewpoint? So the answer is that no, because it's a mandatory income trust. You are going to be carrying out that trust accounting income, and you're not making any excess of it. So the 65-day rule would not apply to a simple trust. We had several questions on that, and so it would only apply to a complex trust. Now, one thing that people conflate a lot, a mandatory income trust. As Laura said, you can have a mandatory income trust that distributes principal. It's still a mandatory income trust, but it is not a simple trust. It's a complex trust. You still get the automatic deemed distribution of the trust accounting income, whether it's a simple trust or a complex trust. So you still get that automatic. And the whole point is that any distributions above the trust accounting income, that is when you would be looking at the 65-day rule. And so you may have converted your trust to a complex trust by having capital gains that you then distribute. But that's fine. There's a difference in your deduction. Instead of having an exemption of $300 for simple trust, you have an exemption
versus
of $100. Yeah, for the complex. Well, that's not really material. So then there's another question here. Does the trust document have to tell you whether capital gain is allocated income? And the answer is absolutely not. Under the law of pretty much every state in the country, you can check your own law to see whether it applies or not. But trustees have plenary authority to make tax elections, and so So the trustee can make that decision. Now, a trust agreement might instruct a trustee to make a particular tax election, but I generally would try to avoid doing that.
That's not something that we would typically see, and it obviously reduces the amount of flexibility you have if you force it one way or another without really knowing how things play out. So that's not something we would typically put in one of our trusts.
Right. So then we have another question. Do you have to pay out the proceeds from the sale of a capital asset in order for the gain to be included in D&I? Or is the payment of the amount of gain on the sale of the investment sufficient? And of course, we really have two different variations to this question. So one is, what if the trust directly owns the asset? And then the other is, what if you have some other issues, relating to the like a pass-through entity or something like that. If the trust directly owns the asset, then yes, you need to pay out the proceeds, but you could refer to it. Instead of tracing it, you can refer to it when you make your discretionary distribution. If you have a pass-through entity, then I mentioned before that the capital gains may be considered to be trust accounting income automatically, and yes, you do need to pay it out, but you don't really have to do a specific reference to it or a specific tracing. We had a question, if the trustee has historically allocated long-term capital gains to principal, how can the trustee convert the trust to allocate long-term capital gains to D&I? Well, the answer is that question is relevant to that second test, and the third test talked about actually distributing or referring to the capital gain. So if you refer to the capital gain, you're under the third rule instead of the second, and you're okay. So let's change our paradigm. Okay, then there's a question, when do you think we'll have eligible designated regs under the Secure Act? This has to do with employee benefits, and the answer is they'll do it when they're ready. Okay. Laura,
we might have time for one more. No, yeah, I think we better wrap it up here.
Okay,
I think we're going to wrap it up here.
All right, we'll wrap it up here. Again, submit your surveys. We really appreciate it, and we look forward to having more contact with all of you. And if those of you didn't get your questions answered, rather than going through these, if you have something you want to talk about, just go ahead and email us, and we're happy to set up a time to talk with you. Thanks.
Thank you.